Hello, good evening, everyone. Welcome. My name is Rohan Mills. I am an assistant director here at Florida Atlantic University's College of Business and Executive Education. Welcome. Thank you for joining us. We're excited to have you. And tonight we are going to be participating in this wonderful session, which is on the housing market in South Florida during COVID. So we look forward to having you join us for this with Dr. Johnson. Before we have Dr. Johnson join us, our speaker, we want to let you know that following the session, we will be going for 45 minutes. So in the last 15 minutes of the session tonight, we will be having questions and answers. So feel free to use the raised hand icon on your screen so that you can ask a question. You'll be unmuted and you'll be allowed to ask a question then. Some of you may want to use the chat on the right-hand side of your screen. So feel free to write in your questions in there and we will get to those at that time as well. Our speaker for tonight is Dr. Johnson. Dr. Johnson is our Associate Dean here in the College of Business, and he's also an real estate economist. Dr. Johnson has had his own company for 12 years. So he does have a wealth of experience in the industry. And without any further ado, I'd like to introduce Dr. Johnson to you.
So thank you, Rohan. So a couple of things. My name is Ken Johnson. I'm the Associate Dean of our graduate programs here at FAU's College of Business. I do have a real estate background. Prior to becoming an academic, I was in the business for 12 years, had my own small company. I then went back to school, PhDs from the University of Alabama, came to South Florida in 2001. And so I constantly keep track of the market here. I also do almost all of my research is housing related, and that's what we're going to talk about mostly tonight. Will be residential housing or residential housing types, not so much on commercial, but I want to talk about where's the housing market right now. It's a very hot topic. I get contacted by the media on a fairly regular basis. So do many real estate economists at this point in time. So we're going to spend some time. I'm going to show you some things that I think will help you know where we are right now in terms of where we are in the housing market, help you make more informed decisions. And that's really the goal here, is not to tell you what to do, but to give you some information to help you make more informed decisions. But I'm also going to provide for you tonight some items that will help you as we go forward, and they'll be simply just links, and you can click to those links and you should be able to gather some information. Some more than others might be helpful, some might be pretty boring, some might be very, very helpful. So what I want to do, I'm going to spend about 45 minutes talking to you guys. If you do have a question during these 45 minutes and you want to use the chat, just type it in and Rohan will be monitoring that. After 45 minutes, I'm going to stop and then take Q&A. And if you'll just raise your hand, Al is with us, Al Campbell's with us. We got an overabundance of IT folks. This is only our second or third time that we've done this. So we've got an overabundance of IT folks that are going to help us move through the night. So Al Campbell will be managing any questions that you have, and you'll raise your hand. Al, can you come online for just a second and speak to everybody? Can you tell them where the icon is for them to be able to raise their hand?
Good evening, everyone. Yes, the icon to raise your hand is located on the right-hand side of your screen near the chat function. It will just say raise hand, and I will be notified on my end, and then I will inform Dr. Johnson that you have a question. If I do not get to you in a timely manner, I do apologize, but we will have a session at the end to go over all questions.
Sure, and this isn't my first rodeo, so I'll work with Al and work on that again. So you can type in some questions that Ro will manage, and we'll work all this together. You've already should be able to notice that you can hear me, you can hear the IT technology, we're going to be able to hear you. It's going to be rather seamless when we get there. So those are kind of the ground rules for the Q&A. So a few things you're going to learn about me is I can't see that well, so I'll be putting my glasses on quite often. The other thing is I'm used to more setback cameras, and I'm going to be delivering from information that's on the screen. So if I'm looking down, that's not me being rude. I'm actually looking at the information on the screen. Right now, I should be looking directly into your homes because I'm staring right at the camera right now. So with that said, let's spend a little bit of time about the housing market in Southeast Florida and COVID-19 and what's happened basically in the last year. I'll preface everything I'm going to say by pretty much about 14 months ago, myself, along with numerous real estate economists around the country, said the real estate housing market is going to tank. It is going to go under. People are not going to go out and shop for homes in an environment where there's a virus that's highly contagious and deadly. The housing market would just close up. And then we were shocked to see not only did the market not close up, but it actually started to accelerate. Well, why was that? Well, I'm not really sure why we never had a down month or so, but we now have a pretty consensus opinion of why the market has taken off so much. So a number of things came together. Number one, interest rates started to fall precipitously as the government got geared up to stimulate the economy. So our overall interest rates, and namely for people interested in housing, people that were interested in that 30-year mortgage rate to finance their home, that rate was falling precipitously. So it was getting rather inexpensive in a relative basis, on a monthly basis, for ownership of a home. Rates went from high threes to they were down, high threes, low fours, to they were down below 3% at one point in time. So there were these record low, historic lows in the mortgage market where you're going to go out and finance a home. What else happened, especially here in Southeast Florida? And I'll go back over some of this later on. Southeast Florida always has a lot of people moving into it. Florida has a lot of people moving in. We average about 150 to 180,000 a year. In this past year, estimates now have us at almost 250,000 people have moved into the state in the last year. So you have this huge population influx, demand for housing. You've got record low interest rates, and housing prices hadn't quite taken off late last spring. And so everything was a really good buy. Also, what we tend to have here, especially in Southeast Florida, is a huge inventory shortage. We're constrained. We got the ocean to the east and the Everglades to the west. So we have this narrow strip that we can develop on. It's not like being in Manhattan where land is really scarce, but we're very much constrained, and there's all sorts of environmental rules for development and the urban boundary line. A number of things have all come together to make developing new product, building new homes very difficult here in Southeast Florida. So to sum all of this up, and then I'll add one more thing on top. We have a constrained supply. We've got tons of people moving in. We have record low interest rates. All of those things tended to raise the price of houses and the interest in ownership in Southeast Florida. But the coup de grace that seems to have come to be for this to make the market then take off was the willingness of the public to buy property via technology, to use Zillow, Redfin, who else is out there? Realtor.com. There's a number of third-party information providers that readily can bring information into your home that's very detailed, as good or nearly as good as the MLS system that the real estate brokers work from. So you could see what was there, what they sold for, et cetera, number of pictures, virtual tours, and we began to see a lot of people buying properties without ever physically going inside of them, or maybe making a minimum number of visits. So those things tended to come together, and slowly but surely we started to see housing prices rise. That was kind of shocking, but as we looked at this, well, this kind of makes sense now. Again, low interest rates, people moving in, constrained supply, all pushing up prices. Now we have people willing to buy without physically going into the home or minimizing the number of visits into properties before they make their purchase decision. All of this leads to a rise in prices. So where are we right now? All right, so I put together a number of things. Something else you'll learn about me, if I hadn't already said it, is that I absolutely hate PowerPoint. I think it makes you sleepy on the viewing end. And I just don't like it. So I like Microsoft Word. I'm going to send you all of this information, or I'll have Ro and the group here send you all this information once we're done. And it'll be these live active links that I think will help you the most. So let's first off, we'll start to talk about housing values. So this is a project that I'm working on right now, and this is just the beginning of this particular project. It's a beginning of an academic paper. Let's see if we can play with the sizing a little so it can all get on the screen. So what you're looking at right now are housing prices in Southeast Florida defined. This, I pulled this from Zillow data. It's an open source data platform, and then created this particular, we did some measurements, and we run what's called a trend line, a time series, linear explanation of prices through it. That's all squawky stuff. Don't worry about that. We kind of want to know, where have prices been and where are they going? So, and what we have here is also called a repeat sales index. It's very much like the Dow or the NASDAQ. It's an index. So you can't look at a particular value and know what the value of a house is, but you can look at a particular value and compare it to a future or past value, and then calculate the average percentage increase in housing in this Southeast Florida market. And this data is defined as properties. These are residential properties that sold in Miami-Dade, Broward, and Palm Beach County. It's traditional residences. It's not the condos. So this is housing. Many of these are in homeowners association. Many of them are not, but it's residential housing. We could have done this with condos. We could do it with whatever we were interested in here, multifamily, et cetera. But we wanted to look at housing, or this is the particular of interest tonight for what we're discussing. So what you have on the left-hand side, what would be called maybe your y-axis, is called a repeat sales index. This is a housing price index that we create. So we pull the Zillow data, we morph it into the index scores, and then we plot out those index scores through time. The data goes back to January 1, 96 through 2021, February 2021. The new data comes out next week. It's not going to change that much. So what this is, these are housing prices. So I can look at these values and tell if housing prices are going up, going down, going up again, maybe a little pause and then start it up again. You know, you can tell in here for prices, when you start to see a little space in between the different dots, each dot represents the average housing value for a particular month. When you start to see a little daylight, if you will, between these dots, that means the price appreciation here where we're going up is rather significant. Here, when you start to see a little daylight between the dots, housing depreciation is rather significant. If you'll do the math, I'm sorry, I just have months here. This right here is at the peak of this is right at 2006 and 7, the peak of the housing cycle back that 15 years ago, right? Back at right before the last crash. This is 2012, the bottom. This is January 96, and this is today. So when the dots, you don't start to see daylight and you start to see them almost overlaid on top of each other, there's very little price change going on, right? So, well, what's the red line? The red line is the red line is where prices should be based on this 6 years plus worth of data. Based on price performance, where should it be? Well, clearly back prior to, this is right about 2000, by the way, then you can see prices are actually below where they should be. Good buys. People started buying, prices accelerated significantly. And this is right at 6 and 7 when the market peaked in Southeast Florida. It peaked at different times depending on where you were. Then we had a housing crash. This is 2012. Prices started up again, right? It's not a perfect movement, but you can tell on average housing prices have been moving up since 2012. They're not quite where they were. They're very close. It depends on where you are. Maybe one county is where it was on average and one county is not, or one particular house is where it was back in 6 or 7, one is not. But this is, again, I can measure, or we can measure percentage changes. So the red line is where housing prices should be. The blue dots, the little path that it curves out, is where they are. So that leads us to be able to make a couple of conclusions. So we can look here in 2006 and 7 and see, boy, housing prices were way above where they should have been. In 2012, housing prices were way below where they should have been. We weren't surprised when housing prices began to rise in 13, 14, 15. Quite honestly, many housing economists were not surprised that housing prices fell after 6 or 7. They just got too high. They were too far above where they should be. Well, what does that tell us about today? Well, this is an easy picture to look at and get a feel for. Here's where they were. Here's where they should have been. Here's where they are, right? This is as of just 30 days ago. Here's where we should be. Clearly, today, we are above where we should be in housing prices in Southeast Florida. But we're nowhere near as far above where we should be like we were back in 2006 and 7. That to me is really good news. I know I'm on the upside, right? I'm on the upside of what's called a housing cycle, up, down, up. So I'm on the upside of the housing cycle. And is it peaking is the next question. We'll talk a little bit about that. But wherever it's going to go to, it's above, prices are above where they should be, but not as bad as they were that 15 years ago. So to me, that's good news. So if you take one quick look at this picture too, you can tell how these dots start to get really close together. And what's happening is the rate of property increase is decreasing, is declining slowly. So it's going up, but it's going up at a slower and slower and slower rate. And then ultimately it starts to turn down at a fairly low rate, and then it starts to accelerate. So you can see all these little dots start to group together and start to turn over. So something unique is happening, especially in these last 12 months. Not only are the prices going up again, they tend, if you look really close, you can see the little space is developing between these dots. So prices are going up at an increasing rate. That to me is a little bit alarming because I'm worried, could we get back to here? I just don't think so, because so many things are going on. So the takeaways from this picture are, we're above where we should be, but nowhere near as bad as we were 15 years ago. We also know that we're on the upside of the housing cycle. So if we're buying, we should be able to look here and realize that, boy, prices were so low and they were way below where they should be. You know, a third grader can make a good buy in Southeast Florida in 2012. You had to get a little bit more aggressive with your negotiation as we move through time. And now here we are, and prices are going up, and there's a lot of buyers. A lot of people are coming into Southeast Florida. A lot of people are looking to move up in Southeast Florida. So you got to be a little bit more aggressive about how you negotiate. And you got to be less afraid to walk away from that property, because there will be another property. But I would tell people now, negotiate aggressively and don't be afraid. Never buy today because you're afraid of where prices are going to go tomorrow. That's well established in stocks and bonds and other financial assets. And it's true in housing too. Don't buy today because you're afraid the price is going to be too high tomorrow. As you can see, through time, housing prices cycle. So that's one link that I've provided to you, and we'll try to come back to that. By the way, the data source was Zillow. If you are kind of a data file and you like these sort of things, let's see, Zillow should open up here. Come on, open sesame. Well, Zillow's not opening, or I don't see it opening. Al, can you help me here, please?
You're gonna press Control and then.
That's what I'm doing. Ah, here we go. Okay, so I jumped actually to the alternative housing site. So that's Zillow, where are prices now? So let's leave this one open for just a minute, come back. These links should all be, there it goes, sorry. It's the operator error. So you have Zillow data, you can download if you really love working with Excel. These are sources for you. I might not be, you know, in your back pocket 3 years from now when you're buying again, but these links should be good for years and years to come. So the data that we use to produce the raw data that we use to produce this picture comes from Zillow open source data. Another source of what's called a repeat sales index is FHFA, house pricing index, and all this stuff is freely available. It's open source, and you would want to go to, I always like all transactions as opposed to purchase only. You could look by state, metropolitan area. This is the one that I like. It's another Excel file or Excel type file that can be used to be put into Excel. So why FHA data? Why FHA data versus Zillow data? I like Zillow. This has nothing to do with it. It's newer than the FHA data. The FHA data goes back about 40 years. The downside to the FHA data is it only comes out quarterly, and a lot can go on in 90 days. The Zillow data and Realtor.com has a very similar database. These databases come out monthly, and you're more able to track what prices are doing. So those are just two data sources for you on where housing prices are, and based on trends, where should they be? Excuse me. So just going back to this picture for one moment. Excuse me, I'm about to sneeze. Sorry, but that was cute on camera. I apologize, guys. We do calculate this number here. I've calculated this number here, and it's 11.5%. By the way, I didn't put this on the graph, but back in 2006 and 7, we were over 65% above where we should be. Today, we're 11.5%. Am I concerned? Yes. Am I petrified? Am I worried? Is it going to be another housing crash? I just don't see any evidence of that. So, data sources. I wanted to talk just a little bit about rents. Most of this is not about rents, and I don't do much active research on rents, so I don't have a link someplace on the internet for you to go to, but I wanted to show you a little bit about rents in South Florida. And this comes from Zillow. It's what's called a repeat rental index. So they're looking at the same property, what did it rent for in the past, and 5 years later, then 7 years later, or 13 months later, whatever it is, when it re-rents, they can take this average and extrapolate into what's happening with rents in the marketplace. So it's called ZORI. It's just a repeat sales index that's put out by Zillow, and it's from the Zillow transactions. So does Zillow have everything? No, neither does the MLS. No one database has everything, but the sample sizes are large enough it truly mimics what's going on in the overall market. So what I've heard so much, and this, by the way, this data only goes back, I believe, roughly 2000, starting in 2014 to today. And what you hear about rents all the time is rents are skyrocketing, rents are skyrocketing. And the truth of the matter in Southeast Florida, and by the way, most places around the country, is no, they're not. Rents, no matter where you go in this country and pretty much anywhere in the world, rents tend to be very, very, very stable around a long-term trend. You notice they're just not as volatile as the housing prices were. Let's go back up here and open that housing price thing back up again. So again, this is price on this axis, time along the x-axis, and just a lot of volatility. When we look at rents, and again, I chose to show you some, I don't regularly research rents, but housing prices are based on rents. There's just not that much volatility in rents. Rents are going up in Southeast Florida. Currently, rents in Southeast Florida are about 1.04%. You can, the blue, I didn't turn this line red, my apologies, but this little blue dotted line, that's where rent should be. And the actual blue dots, this path that's traced out, is where they were. Clearly, rents started to drop at the first of the pandemic. There could be many explanations for this. They've been rising lately, and now they're above their long-term fundamental pricing trend, where they should be. But is it really? It is a sample. It's only 1% above where it should be. Causes me no angst whatsoever as a housing economist. Rents on average in Southeast Florida have risen 3.4% 4% in the last year. So go back 12 months, rents on average, when you look at all the properties that rented, all their size, their amenities, et cetera, they went up 3.4%. So these are adjusted for amenities, size, location, et cetera. So when you see apartment rents going up, maybe that's that one apartment, and you're not hearing about the rents that aren't going up or perhaps even going down. So on average, the average rental appreciation in Southeast Florida in the last year was 3.4%. When we go back again and look at this picture, I didn't think about doing, oops, I'll need that open. When we go back, excuse me 1 minute, again, operator error, still operator error. I'll stop closing this is what I'm going to do. When we go back and look at this picture, if we go back 12 months, I can tell you based on this data, housing prices went up almost just short of 9%. So the stuff that you hear about the median price jumping, that's a bad statistic of 20-something%. That's not accurate. So housing prices still move more dramatically than rents. I see what happened there. Thank you very much. We'll close that again. So rents are going up. They're pretty stable. They've only gone up 3.4% in the last year. And amazingly, since 2014, the average yearly increase in rents for the average rental property in Southeast Florida has only been 2.8%. So yes, rents are rising, not as dramatically as perhaps we see in the newspaper. Prices are rising, not as rapidly as we perhaps hear on the news, in the media. It's mostly just bad statistics. I don't think anybody's trying to purposely trick you. They just don't have the right data to look at, and they have sampling error and all sorts of other potential issues. So what do we know so far? Prices are up, not as dramatically as they were 15 years ago. Rents are rising, not as dramatically as what people say they're rising, and they're very stable. Housing prices in Southeast Florida, and this is true around the rest of the country, are very volatile. Even though rents stay relatively stable, housing prices tend to fluctuate up and then fluctuate down, especially in the last 20, 25 years. All right, so let's create a little bit bigger picture here for you to look at. So this led to some research. These patterns of rents and values led to some research that I conducted with a gentleman named Eli Braha. Eli is a professor at FAU. And after we published this, we brought on a third researcher to not only did we have the publication, but now we wanted to provide something for the public. And we produced what is called the BH&J, Buy versus Rent Index. BH&J stands for Braha, Hardin, and Johnson. I'm Johnson. I'm the oldest. That's how I got to the back of the line. And we produced this with the FHA and another set of rental indices. And what we're trying to do here is actually create some pretty pictures for people to make more informed decisions in roughly 23 cities around the country. And we've been putting this out for about a decade. It's on our college website. The data is open source. We don't track web addresses or anything. We put it out quarterly. And what we're able to do is we can look at 23 metropolitan areas around the country and then treat them as an amalgam of the country and tell you, on average, should you be buying or renting in a given market to produce, on average, more wealth? In other words, if I'm living in Southeast Florida, on average, am I better to rent and reinvest monies that I would have spent on ownership? And so therefore I'm renting, but I'm saving and putting money into a portfolio of stocks and bonds that I would have spent on ownership. Or am I better to take that money that I would have spent on ownership, including the down payment and things like maintenance, taxes, insurance, et cetera, and buy the home instead and create wealth through equity appreciation, right? So which way on average is better? And that helps you perhaps make a little bit more informed decision. If you can see this, which I hope you can, we're going up, we're right here at the beginning of 2021. You see everything north of 0 is you're in rent territory. Everything south of 0 is you're in buy territory. And this is for the US as a whole. And just as expected, by the way, when you're at 0, it's a 50-50 chance. 50-50, you're better off renting and reinvesting or owning and building equity. It's a tie. When you're up near 1, you have virtually no chance of owning and beating renting in terms of wealth creation. When you're down near -1, you have virtually no chance of buying and beating renting and reinvesting. And given history, exactly what we expected around the US was, boy, back around 2006 and 7, the market peaked. And when we looked, and all we simply did was create what was called a horse race of wealth creation. Which way on average will produce more wealth? And we're trying to project the markets forward. So we either have a portfolio of stocks and bonds that we're going to reinvest in if we're renting, right? Or we buy the typical property in a typical area. And so what's going to happen? And we did this for the US as a whole, 23 cities. And one of our 23 cities, lo and behold, we call it Miami. That's because we put it out around the country. And if we try to explain about Boca Raton to people in Minot, North Dakota, they don't know where that is, but they all know where Miami is. So this is Miami Metro. So if you look at this again, which I hope you do, because you might not always live in Southeast Florida, know that this is Metro Miami. And when we say New York City, we mean Metro New York City, whole 19 million people spreading over into New Jersey and Connecticut. So, but when we look at Southeast Florida, which we call Miami here, boy, there was virtually no chance ownership could beat renting. You were in rent territory, and back in 6 and 7, if you were buying, there was virtually no chance of you creating more wealth by owning and building equity versus renting the same property and investing the portfolio and investing the difference into a portfolio of stocks and bonds. Boy, around 2012, this is looking a lot like the other graph that we looked at, only this is which way wins, renting and reinvesting or ownership and building equity. And that's because these two things should follow each other. Market kind of intuitively picks up on this. People intuitively pick on this. I don't pick up on this. I don't think they're making the calculations. But boy, down here in 12, you were getting all sorts of buy signals. And there is research out there too that shows that this BH&J score for given markets predicts where prices are going to go to a modest degree. It's not perfect, but it predicts where prices are going to go to. So we were not surprised in 6 and 7, and we did this through what's called backwardation. We worked backwards because we did the work roughly around 10 is when we began to work on this. We weren't surprised that these scores were sky high. And then when we got down here, we weren't surprised that these scores here, you notice this is minus, so it's getting smaller. And we were like, boy, this is a good buy sign, you know. And today, so where are we? If we truly are on the verge of another real estate bust, why isn't this number, these scores, which is, I don't know, 0.2 or something. You can download the data too, by the way. All the data is in an Excel file. Sorry if I'm making you dizzy. Click here to download the data. It's, again, we're not tracing anybody. You can download it, it's free. We're trying to help you make more informed decisions. That's what my job is. You know, you're just expanding my classroom tonight, by the way, and I enjoy that. So, oh, there we go. Why isn't this score now, instead of being 0.25, 0.2, whatever it is, why isn't it back up here by 1? It's because there's just not that much downward pressure on the demand for home ownership in Southeast Florida. Why is that? People are moving in, interest rates are at near record lows, right? All those things that we talked about before, limited supply. People are buying homes now using virtual technologies. They're viewing and making inspections and making offers without perhaps even physically going into the home. So there's a lot of housing demand. So you do need to ask yourself too, well, why then, if renting on average creates more wealth, when you're above this 0 line right now in Florida, odds are you're better off to rent and reinvest than buy and build equity. Well, then why aren't more people renting and reinvesting? And that's the reason for that is housing, your home, your place where you live, is something more than a financial investment. And so when I see scores at 0.15, 0.25, 0.3, I don't really get worried, because you have certain homes that are areas that you want to own and live in and make sure your kids go to the right schools. You hedge against rising rents, even though they're not as high as rising as rapidly as you think, but you don't know, most people think they are rising rapidly. So you want to hedge against that, and you want to make sure you have the right amenities. You want to entertain friends and family at your customized home, as opposed to a more uniform rental type product, perhaps. There's things that you want out of the house other than just a financial investment. These scores right here don't worry me. I mean, could we have a downturn? We could. It shouldn't be severe, right? And so these are just people right now that are buying because, you know what? I want to live in a certain neighborhood. So then the question should become, and I don't have it on any slides tonight. You say, Dr. Johnson, you say right now in Southeast Florida, renting and reinvesting in a portfolio of stocks and bonds should be about 60% stock, 40% bonds. And you can set that up with your broker that will be just roughly as volatile as this housing market is here. Even if you don't get that exactly right, or to the exact pinpoint, right, on the level of risk, why would you say ownership's okay? And I'll explain to you why it's okay. And renting is okay too, as long as you reinvest. There are only 3 states in the world. We'll set aside homelessness for right now. That's something outside of the scope of what we're talking about tonight. There are only 3 states in the world for how you put a roof over your head and your family's head. Number 1 is you could rent and not reinvest. You could spend that money on beer and cookies. I'm kind of quasi-notorious for saying that, but you're going to spend it on consumption. You're going to, rent that property. You're going to go out and take the nice vacations, buy the boat, do all the entertaining type things, as opposed to reinvesting. So that's state 1. That's possibility 1. Possibility 2 is you could rent and reinvest, right? In that portfolio of stocks and bonds. You would reinvest that money that you would have otherwise spent on owning that particular property, right? And then number 3 is you can buy and build equity. And the truth of the matter is, option 2 and option 3, even though renting and reinvesting wins, this picture doesn't show you the magnitude. Let me check the time here. I don't want to run out of time. We got just a few more minutes, so I'll speed this up a little bit because we started at 6:30. So it doesn't tell you the magnitude about how much renting and reinvesting wins. And the answer is not much. So really what you should be doing is either renting and reinvesting or owning and building equity. Don't do option 1, renting and spend the difference on beer and cookies. So in Southeast Florida, I'm not a little worried that housing is a little overheated right now. You're going to create wealth that way. Maybe you'd be a little bit better off renting and reinvesting. However, you don't have the niceties perhaps of, I want a certain pool. I'd like to have a cage around my pool, and I can create it. I can build the property like I want it. It'll be mine. It'll be customized to me. Both ways create wealth. Ownership is a forced savings plan. If you feel like I don't have that monastic discipline to constantly reinvest every month, that money's that, I put the down payment in, and now that difference that I would be spending on ownership, I'm going to take that monthly and I'm going to stick it into a portfolio of stocks and bonds. If you don't have that monastic discipline to do that, for goodness sakes, own and build equity. If you feel like you're a little bit more disciplined saver, you're probably a little freer to rent and reinvest. If you're thinking only in terms of total wealth gain, right? Valuation gain, renting and reinvesting wins in Southeast Florida, but not by that much. What loses in Southeast Florida and everywhere else is renting and spending the difference on beer and cookies, spending it on consumption. Don't even consider option 1. Only consider option 2 and 3. And in the end, that horse race, which way is going to create more wealth? Renting and reinvesting is going to win on average in Southeast Florida by that much. So you could take that into consideration. It's not so dramatic that you're going to see big swings in prices. So let's close that up for a second. We've got about 5 minutes, and I've got more kind kind of like so many of the things that I do, I bite off more than I can chew, but this data is going to be available for you. And the links will be available. I want to talk to you a little bit about mortgage rates. So these are more national. You don't really, in the old days, you could have mortgage rates for one part of the country that might vary from other parts of the country. Today, that variance is very, very, very small. So I want to talk to you a little bit about mortgage rates, because that's probably the greatest threat to housing prices in Southeast Florida and around the country. Mortgage rates went down, housing got cheaper, the demand for housing went up, prices went up. If interest rates rise, the periodic monthly cost of ownership is going to go up to people. So just imagine if interest rates went from around 3.1 to 3.1 or 3.2 where they are today to 16. Clearly how the demand for housing would plummet, prices would go down. So that's not going to really happen. So where are they today? I have a few links here, and these are to Fred. This is the 30-year mortgage rates right here. This is the 10-year Treasury series. So again, because of time, I'm just going to jump to the bullet points. The historic spread between 30-year mortgage rates and 10-year yields is about 170 to 190 basis points, or 1.7 to 1.9%. They found that historically 30-year mortgage rates, there's a lot of reasoning behind it, but let's just take it as given now. 30-year mortgage rates are tied to 10-year Treasury yields. That's the government borrowing money on a 10-year basis, right? So where 10-year Treasury yields go, and the causal is the Treasury, not the mortgage rates pushing on the Treasury. It's the Treasury, the demand for those Treasuries and the supply of those Treasuries that sets the price, or the yield on those Treasuries. And then you could add about 1.7 or 1.9% to that, and you'll see roughly where rates should be, right? So what's going on right now? Currently, the two databases above show the mortgage rate. If we click in here, the last mortgage rate right here and that was from Freddie Mac, I believe, is 3.04. That's the average rate around the country. And the 10-year Treasury yield is 1.56. Well, wait a minute. If I add either 1.7 or 1.9% to 1.56%, then I'll see that the rate should be somewhere between about 3.26 and 3.46%. But rates are actually more like 3.1, right? 3.1, 3.2. Rates are below where suggestively they should be. They should rise. But if they do rise, they should rise somewhere in the range of 3.23, let's just call it 3.25 to 3.45. Those are still near record low interest rates. I encourage you to, if you watch the news, those business networks, watch CNBC or Bloomberg, and they constantly give you this 10-year Treasury yield that somewhere shows up on the screen every morning. And if you'll just add this number right here, 1.7 to 1.9, you get a good feel for where mortgage rates should be or should be going soon. So we should expect there's going to be slight expectation for 30-year mortgage rates to rise, but not go through the roof. I don't think prices are going to be so susceptible to change that 3.3, 3.4, 3.2 are going to force pricing down in Southeast Florida, or really anywhere else in the country. If the 10-year Treasuries, on the other hand, start going up rather rapidly, again, add that, what's called a spread, 1.7 or 1.9 to that, and you'll see, boy, rates are going up, and rates, to me, I'm thinking we get somewhere above 4, you're going to see a slowdown. My goodness gracious, if we get to 5 or 6. And by the way, I've lived in an environment where it was much, much higher than that. But boy, a 5 or 6% 30-year mortgage rate right now would crush housing, not only in Southeast Florida, housing values, not only in Southeast Florida, but all over the country. So let me close up. I add a few more websites for you. I encourage you to use Zillow or Redfin or Realtor.com and look at the sold sections and get out and do your due diligence. People think I'm going to buy a house very much like I buy a hamburger. Yeah, well, I'm telling you to use the technology, but use the technology like the realtors use it. These databases have, in some instances, more data, more information. You can highlight your neighborhood, go look and see what's sold in the last 6, 9, 12 months, drive by the properties, do your due diligence. You can price better and get a better feel for the marketplace. There were some other points in here. Stats America tells you about the number of people that are moving to Southeast Florida. It's phenomenal. Palm Beach County, we looked at creditworthiness. This is something that's kind of not well known. The percentage of subpar credits in Palm Beach County, and you can do it by Miami-Dade or Broward. I just chose Palm Beach as the proxy here. It doesn't change that much. Is at a near 25 or 30-year low. When we had our last housing crash, the number or the percentage of people with, let's just say, less than stellar credit was at a record high. Today it's at a record low. That's also suggestive that we're less likely to have a housing crash now than perhaps we did those 15 years ago. I don't see a problem. There's a lot of people running around with very good credit in Southeast Florida now, a lot more than there were 15 years ago. Inventory, there's another link there. Inventory is short. And then finally, there's Palm Beach County income. We'll show you this one real quick. It does tend to lag behind by about a year. This data is hard to collect, but you hear income. I heard today somebody say, well, you know, incomes are going down in Palm Beach or in South Florida. And the answer to that is, and this is FRED, Federal Reserve Economic Database. The answer to that, at the end of 2019, the average income per capita personal income in Palm Beach County is $83,000. You can go back by year. You can see that in 607, it was 62,000 and changed, went down, and it's been rising again basically since 2009 from around 52 to 83. That's a huge increase. People are making more money in Palm Beach County today than they were just a few years ago. Interest rates are at record lows. Credit scores are sound. We're a little bit above where we should be in pricing, not dramatically so. So let me close up some of these things. And I'm going to send you all of this information with the links, and you can have a party with that if you want. Oops, I think I just cut off the Zillow. Al, did I cut off the Zillow?
The Zoom.
The Zoom, sorry. I just panicked.
No, you're still here.
They can still hear and see me, right?
Correct.
Okay, my apologies. I got a little zealous there. I'm watching the time. So we might go a few minutes over.
Oh. We have 50, yeah, but that's.
We'll be okay, all right. So I wanted to have some time for conclusions, and notice I wrote it in to you. Those are left up to you. I can't make a housing decision for you because it is a personal decision. Every house is different. Every little neighborhood's a little bit different. But what I can help you with is give you some information that helps you make more informed decisions. And on average, they'll make better decisions. You know, a number of you are current students, some are prospective students, some are past students, are graduates. But I'm going to do a seminar in real estate this summer in our executive master's program, where you can take this class and we'll get more into detail. How did you get all these numbers? How did you build this? And show you how to do it rather than just give you the information right now or give you a source of it. So that's going to be there for you. It's going to be what the class is about. So if any of you, or especially if you're current students and you're interested in enrolling as the elective for the summer, we'll do this sort of thing and more for the summer semester that the class is available to you. So with that, I want to shut up to get closer to our timing. So I'm about 4 minutes over. We'll stay until you, hopefully, we'll stay as long as you've got questions or a reasonable amount of time. So Al, do we have any questions right now?
Yes, we do.
Oh, wow. Let's try it again. Who has the first question, please?
Daryl.
Yes.
I have one from Daryl Donato.
So Ro, you go first. Daryl, what is Daryl's question, bro?
Daryl says, interest rates inversely affect corporate valuations. How much do you see rising interest rates impacting property valuations in an income-producing real estate portfolio? Okay,
A little bit different, but that income-producing rentals are a lot more sensitive to interest rate changes than homes are. And the reason is, again, the home, you're having fun, you live there. Rentals, they're like a bond. So interest rates rise too much, they are far more susceptible. I'm a lot more worried, and to great extent, not hugely worried, but relative to residential homes, I'm more concerned for income producing property values in Southeast Florida than I am for residential home values. Is that, hopefully that's good for Daryl. Al, can you go with the question? Who has a question, please?
Yes, the next question is from Kira. Kira Simmons, what suggestions do you have for building a home right now?
In Southeast Florida. Wow. I own an existing home that was remodeled. I felt like I got more money, more value for my money in the existing home that was remodeled, and then my wife and I put a little bit more into it. New product in Southeast Florida is particularly expensive for some of the reasons we mentioned earlier: tight inventory, difficult to develop, constrained lands. You're going to see, if you're going to really want that new product, you're going to probably be moving more to the north end of this 3-county area where there's more land to be developed, less restrictive rules and regs for developing housing. I think you're going to see, instead of talking about a tri-county area in years to come, I'll be old and retired by then, older, more seasoned and retired by then. But I think you're going to start to talk about the 5 or 6 county area. So you're going to see more and more people moving into Martin County, up near Port St. Lucie and further north up the coast, because they can develop more easily and more reasonably priced new product there than they can in Palm Beach, than they can in Broward, than they can in Miami-Dade. These 3 counties aren't equal. It's easier to develop new product and buy new product, meaning new homes, in Palm Beach than it is in Broward, than it is in Miami-Dade. So if you're really looking for that new product, you're probably going to find, more likely you're going to be in Palm Beach County than the other 2, and perhaps even thinking about moving into Martin County or further north. Ro, I'll go to you. Do we have another question?
Yes. So as you mentioned, interest rates are the biggest factor. What effect do rates have when the yield curve is inverted?
All right. So yield curves fortunately don't invert for long periods of time, and invert rarely. And right now we can easily fall into an inversion. Number one, it would hurt the economy. Number 2, it would probably hurt housing values. But the inversion is, now we're talking about going from 20 basis point on the bill to 2.5% on the 30-year note. The inversion is not dramatic. Like when I was just getting out of school, rates flipped from to on the short end being at 15% and on the long end being 6%. And that crushed the economy. It's the magnitude of the flip. But anytime you get an inversion, it hurts all financial asset values. And by the way, your home is a financial asset. I know you live in it, I know you enjoy it, but it acts very, very closely like a bond does or like a stock does to the perceptions of risk in the marketplace. The one thing why it's not as sensitive as, say, just a corporate bond or a government bond is it's partly a consumption. You are, again, buying that home because you really like it. Nobody ever bought a stock because it was cute. People buy homes because they're cute. So you don't want the yield curve inverting for any of your financial assets, and it is particularly troublesome for your home, but it will much more, an inversion of the yield curve will hit your portfolio of stocks and bonds much harder than it will hit the value of your home on average. Al, do you have another question?
Yes. Matthew Baker, does Southeast Florida have any historical trend for RE market, real estate market, I presume, such as Florida real estate is a lagging indicator or leading indicator for the rest of the country?
So much as where the rest of the country is going to go relative to us, I don't think any one segment of the country necessarily leads or lags consistently and can be statistically shown to lead or lag other parts of the country. Thank you for the question, though, because our buy versus rent index has been shown in research to be a leading indicator of where prices are going to go. Unfortunately for me and my 2 co-authors on that piece, it's statistically verifiable, but it's not wildly accurate. So it still has errors. In other words, our gain off of it is so small that we've never been able to monetize it, said another way. But it does, if you'll watch that buy versus rent, and when those prices, excuse me, they're not prices, but when that buy versus rent score is going up a little bit, it tends to make it a little bit more rent friendly. And when those BH&J rent scores are going down a little bit, heading towards negative territory, a little bit more ownership friendly. So it helps you, again, make a more informed but not perfect decision. And there's just no leading indicators out there, no matter what people tend to tell you. And if they do have a leading indicator, why are they telling you? So you should think about, I used to think about that all the time, and you can see patterns, but these patterns sometimes break down and they're not necessarily there because there's other drivers behind that. I don't want to get too terribly wonky, but nothing is a perfect leading indicator, but there are suggestive things. And the BH&J is just so happens to be one of those things. And you might not always be in Southeast Florida. If you're in one of those other 22 cities, it should help.
A question from Gabriella. I took his real estate investment. Oh, she's just making a comment. Highly recommended.
Thank you, Gabrielle.
And then Matt says, are there 2 to 3 variables outside of inventory and rates that will help sustain high price increases over the next 1 to 2 years here in Florida?
There's at least one. Well, let me 2. Now, what were the, sorry, tell me again, what were the 2 besides what?
He says, are there 2 to 3 variables outside of inventory and rates that will help sustain high price increases over the next 1 to 2
I'll give you 2. Number 1, and less impactful, is it's just difficult to develop new product here in Southeast Florida. So, and our inventory shortage, then that's going to exacerbate that inventory shortage. So it's not going to disappear overnight. So we're going to probably have this prolonged degree of inventory shortage. So that's kind of the same thing, what you noted earlier. But the big difference, yes, rising interest rates are the greatest existential threat to prices in Southeast Florida. But the greatest corrector of any housing market crash, or the greatest accelerator for any housing market increase, is population growth. Income's another, by the way. So yeah, I've come up with a second or third one. Rising income helps, and you can see it's continuing to rise. And you can go to that link and you'll be able to see it'll lag by about a year. But the number one solver of real estate problems is an increase in population. And Florida is winning on this. Right now, in the last year, 5 states increased their population. I saw this number the other day in the outline. It was 5 states, but forget what the 3, 4, and 5 were. But the number 1 state in increased population in the last year, Texas, with almost 350,000 new people moving in, 375 maybe it was, and then Florida with 250,000. Well, we should have been coming in around 150, 170, 175. Huge influx of population into Southeast Florida. And that link that goes to Stats America, that's so easy. Just type in where you're looking at a metro area or a county, and it will tell you the expected growth in the next 10 years. And this past year, we were way ahead of that expectation. So people moving to South Florida is really, maybe it stops tomorrow, but this huge influx of population is really going to help support pricing in Southeast Florida. Al, do you have any more? And we can open up mics. If they want to just raise their hand, they can open up a mic and ask questions as well.
Yes, Marhish said, are there any other factors affecting inventory levels other than COVID? Will this trend continue for the next couple of years?
So existing inventory levels, that will rise and fall relatively easy, but there's still going to be a little bit of shortage because so many people coming in. What's really driving the inventory shortage in Southeast Florida is we're not building new product. Now that's just code for real estate economists to say they're not building any new houses, or they're not building very many new houses. And we're just going to be lagging behind. And until we can catch up on that, it's going to help buoy up prices. It's going to hurt housing affordability, right? Florida's going to become more and more expensive. So it's always a double-edged sword. If you bought into the market and prices are rising, then you're indexing up, right? If you've decided to rent in the market, as long as you're renting and reinvesting in a portfolio of stocks and bonds, there's not going to be that much of a difference here in Southeast Florida or elsewhere. So that inventory is just not going to change that much. It's difficult to develop the product. Each county municipality has impact fees. Impact fees used to be a small, trivial part of developing a new product or to build a new house. But impact fee was small. The difficulty of building a house was far less. All those things have increased. The degree of difficulties increased significantly, and the cost of developing has increased significantly. And those impact fees are actually hurting. And I know, and I'm very cognizant of being environmentally sensitive, but research is beginning to show around the country, impact fees are becoming a tax vehicle, not necessarily a true offset for actual impact. So you're having municipalities use impact fees for tax generation, or at least some evidence is beginning to show that. And I don't know if that's going on in Southeast Florida. I don't do research in that area, but I don't see impact fees going down. And until they moderate somewhat and we make it easier to develop new products in Southeast Florida, there's going to be an inventory shortage. Too many people moving in, and we can't build enough new product fast enough. Ro.
This message is from Ms. Shaw. Are there any programs that you can suggest that will help with closing down payment to buy a home? Or what route would you suggest a single teacher make to become a homeowner?
There are a number of programs, and I don't have any one in mind, but there are a number of first-time buyer programs that are out there. You have to understand, what am I getting into? So I think you might want to add to that, not for just a single individual looking to buy a home, but just a set of questions you should ask yourself as a family, as a single unit, should you own? So I would encourage you to do the following. So there's a few things. What we find out is that young and upwardly mobile just happen to be highly correlated. You can be a little bit more seasoned like me and still hopefully be upwardly mobile. But if you are truly more mobile or willing to be mobile and willing to move to, say, Atlanta, Georgia for that pay increase, open up professional opportunities to you, and then move from Atlanta to LA or wherever, owning a home is going to tie you to that area. The average cost of the transaction, by the time you consider the cost of sale, the move, is over 10 to 12%. So put that on a $300,000 home, and that's a huge cost. If you're renting, it's more easily to relocate from Southeast Florida to Atlanta, Georgia, or Washington, D.C., or wherever. If you're owning, it kind of ties you to the marketplace, all right? The other thing we find, and this is kind of strange, we still don't have a good explanation for it, but in some of our earlier research, Dr. Braha and I, we found that the more you like amenities, the better off you are to own. And that is being driven by what we jokingly call the kegger principle. So think about college kids and they rent. They're going to, hello, Al, can you mute? There are some folks here? Or is that you, Al?
That was me, my apologies.
All right, sorry about that, guys. So when you have tenants in your home, they just don't take care of it as much as the owners do. It's the kegger principle, right? They tend to have parties. So I teach at a university, so I hear about these things. I don't participate in these things. So, but if you're owning, the amenity costs the amenity. When you're renting, because of the potential for the tenant to take less care of that, the cost of renting those amenities go way up. Okay, wow. I like the base mayonnaise, mustard, lettuce, pickle, and tomato place. Renting might be better for you than owning. But if I really like amenities, I'm going to pay a premium for them if I'm renting, right? So mobility, right? And that kegger principle kind of come into play there. So I'm so sorry, I can't really say which one program is best. I don't research in that area. I don't really dig too terribly deep into that, but these programs do help a lot of people get started. And if you want to own, and it is a choice, I'm telling you though, if you rent and reinvest, your wealth difference 30 years from now is not going to be dramatically different than if you'd have owned, right? Than if you would have owned and built equity. But hey, I want a home. I want to own my home. Great thing to do. You enjoy it. It is a consumption good to some extent. Then these programs can help you get started and get into the marketplace. I think of a friend of mine who lives in Southern California, and he moved there, I don't want to give away my age, but in the early 90s. And he now lives in some fancy neighborhood called Rancho Santa Fe. You can look it up. I hear it's really expensive. But he tells me all the time, the only reason I can afford to do that is because I bought into this marketplace in 1992 or 3. So, maybe now is the time, but you got to understand that you're buying on the top end of the cycle. So again, I apologize for not being able to name one program. Al, do we have another question? Al?
Yes, we have one more question.
Sure.
And it was, what is your take on Zillow entering home buying / home selling market? Also, what about Zillow charging fees to brokers / agents to list rentals? Are agents / brokers at risk of being automated? And I believe that's the last question.
Sure, I think they might be at risk of being, to some degree, extincted. I think I just made up a word. Zillow is coming into direct competition with professional real estate brokers at this point in time. I'm using the term brokers and agents interchangeably. They are truly performing one of the biggest functions that brokers historically performed, which was provide you with detailed data through them. They were the conduit through which this information traveled to help you price the house, to help you find the right property, etc. I don't know, but I can tell you it's a settlement between the National Association of Realtors roughly a decade plus ago, a settlement between the National Association of Realtors and the Department of Justice that allowed Zillow and Redfin and others to become these third-party information platforms and provide this data. The big change was the seller of the property got to make that decision as to whether or not to put it on these third-party platforms, or a third-party platform is, for example, Zillow. Right? And if you put it on one, you put it on all. Anything that went in the MLS went on these third-party platforms. Prior to that, it was the broker that made that decision. And what you saw was just this explosion of information on Zillow and Realtor.com and Redfin and others. You're creating your own competition. Now, that's a double-edged sword. I was a broker. I was a real estate broker. I've sold plus or minus 500 properties at one point in my life. If we lose the accuracy of being able to price this information, and I think we're seeing that accuracy start to decrease because brokers, it's no longer proprietary data for them. They're not putting as much due diligence and care into collecting this data and its accuracy. It's subtle, it's small, the differences, but it's getting more difficult to price property these days. It was much easier to price product 10 years ago, 20 years ago, when they had that proprietary database. Now the cost of that, Al, quit playing music. So the cost of that is, I don't know if, let's just say it is all 6%. It's not, by the way. I don't know if it's all worth 6%. So I like Zillow. I hope you look into things. And Zillow happens to be my favorite. Redfin, Realtor.com, they're all wonderful platforms, but there's going to be this trade-off. And it is very, I could see the realtor population in this country shrinking dramatically in the next decade because you just don't need that many people. You can perform a lot of the functions yourself now that the broker used to do for you. So with that said, again, if you're thinking about taking the class in the summer, if you're a current student or whomever we make the class available to, we'll spend a lot of time talking about real estate brokers. Yes, Ron.
One question from Javier. Materials for building houses has increased on average 50%. Which influence will this have, or what influence will this have on the curve?
Well, I'm assuming they're talking about upward pricing. Yeah, I heard lumber went up 40% in the last 90 days. Those are commodities. I'm not surprised to see, right? They can only produce so much timber, so many bricks, so many nails, or whatever it is we're using to build a house, so many in a certain amount of time. And it's the toilet tissue thing back from COVID. So you're seeing a surge, but those prices will come back down. The disruption should be short-lived, but in that short-lived period of time, it's going to be even more difficult to build new homes than before. So there's other technologies out there. I was really amazed about a month, maybe 6 weeks ago. I think I was watching, I love CNBC at night. It's kind of still, I like the business networks, right? So they were talking about a home that was truly a 3D printed home. And I thought, how can that be? It's not a bunch of little computers printing it. It's a big pour, but they are now able to pour as a single unit and build relatively nice homes. I don't know if that will eventually win out, but there are other ways and other products and other materials that can be used, and we'll find them in going into the homes. They're not guaranteed to be better or superior. I'm seasoned enough to remember as a young man when they were putting in double pane glasses and the window frames were turning to kind of this aluminum stuff, and it all looked high tech and chic. And 10 years later, if you knocked on them, there's water in between them, they're shaky, they're rattly, and nobody has those windows anymore. So I think we're going to see new product come out to try and help keep the cost of housing down, and some of it will work and some of it won't. But you know, again, the materials cost right now, that will ameliorate itself through time. We're having a commodity shortage for the moment. Al, anybody else? Ro?
I have Diana.
Okay.
Diana says, do you see any drastic effects once the moratorium is over?
Moratorium. I'm assuming they might be talking about a mask moratorium. I can go with it from there. So I don't think people are going to go back to viewing houses the way they used to. Get in the car with the real estate broker and drive around and see 20 houses. I don't think that's going to happen. We've let the genie out of the bottle. I think you might see more visits into any one singular house, but we're just not going back to the way we used to. Most homes apparently, anecdotally, appear to be sold today through virtual viewing, holding open houses on maybe Friday, definitely Saturday and Sunday, people coming in and making offers. And so it's a different channel through which to buy. So, but I see that going a little bit back, but the old traditional way of looking and finding and buying and selling your homes, it's going to be different. It's just going to be. I don't know if it'll be as efficient. I tend to think it will be because I think technology really helps with all of that. So, Al or Ro, any more questions?
No, sir.
Thank you, Al.
Question here. Says I have a question. I bought my first home over 15 years ago. When I purchased my new home, would I be considered a new homeowner again? If we are running out of time, it's okay.
No, that's fine. I'll try and address that. That's kind of more of a legal question for some first-time homebuyer programs. It's not legal, it's technical. And I don't know that because different first-time homebuyer programs, they might decide that if you haven't owned a home and I've seen this in the past, but there's different first-time homeowner programs. They might say, if you haven't owned a home in the last 10 years, aha, you're a first-time homeowner. It's kind of weird. Well, no, I'm not, but by definition of the program, you are. So I'd ask you to dig into each program. So maybe you're talking to your lender about that and just tell them the details and they'll be able to tell you. I don't know the exact answer, but I know different programs are different. And I can remember when I was in the business, which has been a while ago, that I was shocked to learn that first-time homeowner didn't necessarily mean first-time homeowner. And maybe it varies with, hey, I bought single, now I'm buying married. I remember that was different. That was one of the ones I ran into years ago, where an individual had bought a home and then because they had remarried got married in the program that they were looking at, they qualified as first-time homeowners, even though he had owned a home prior to marrying, and then they as a couple bought another home. So I hope all of this helps. I enjoy this. We'll wrap this up now. I'm looking to create more informed consumer decision-making around real estate. I can't tell you what you need to do for your individual purchase or sell, but I can help you become more informed. We will send out what we had tonight. The links are really interesting. They should lead you to other links that will help you make more informed decisions. And it shouldn't help you just here in Southeast Florida. It should help you no matter where you move in the country. That right now we do 23 cities on DH&J. We can expand, and we're working on expanding that to over 400 markets because of databases such as Zillow, because of databases such as FHFA. There's just more and more data out there, and you don't have to be that rocket scientist to look at the pattern and the trend. If you do decide to come to the class in the summer, if you take it as the elective, I'll show you a few more details about how to do it, and you'll see it's not that difficult. So, and we're striving, can't guarantee this, to open the class up also to people that are interested in some form of a certificate, so we can kind of show you this. And you don't have to call me every day I remember, sorry, I just said that. I'm sorry, I'm going to digress a little bit with you. I remember I used to ask my stat professor all the time how to do certain things technically. And finally he said, Ken, you know, if I don't make you learn how to fish one day, you're going to bug me the rest of your life. And so I want to get you there. If we can't get you to fishing, we can get you to where you can go find the fish and make better decisions. So treat this more seriously whenever you're buying or selling homes, residential rental properties, the same thing. And I think this is an asset class and it needs to be in your portfolio. And I'll close on this. Research shows, actually research that I was involved in, that everyone's portfolio should contain about 40 to 50% real estate. It could be the home you live in, it could be rental properties, it could be real estate investments trust, and the difference should be roughly split between equity and bonds. So I've enjoyed it, guys. I hope we get a chance to meet one day. I look forward to when people can come back to campus, and thank you very much. Have a good night.